Students, today we will discuss about the past adjustments or the adjustments in the closed books of accounts of partnership. You see, students, what happens that there are so many adjustments or appropriations which are to be taken into consideration, and it may be possible that at the time of closing of the books of accounts these adjustments may not have been taken into the consideration. You see, there may be interest on capital or interest on drawings, salary or commission which may have been omitted, and profits may have been distributed in the wrong proportion. Profit sharing ratio is altered from the some past date. These are some of the adjustments which may affect the closed books of accounts or which may have not been considered in the closed books of accounts. So you see what happens that instead of altering the signed balance sheet as signed by the chartered accountants or the auditors, it is better to just to have a rectification. So how the rectification of errors can be done? You see, there are two ways to do the rectification. You see, whatever we have whatever adjustments we have discussed on account of which have been omitted or which have not been taken into consideration. For that, individually separate adjustment entry for each error is passed by means of profit and loss adjustment account, which is closed by debiting or crediting partners' capital or current accounts as the case may be. So what we can do, we can prepare a profit and loss adjustment account, and individually whatever error or whatever adjustment which have not been taken into consideration may considered now, and this profit and loss adjustment account later on can be closed with the help of the partners' capital accounts or current accounts as the case may be. Another way which is generally used is the single adjustment entry is passed. Instead of passing so many entries, only a single entry is passed and an analytical table is drawn to find out the net effect of all of the adjustments, and for that a single entry is made with the help of the partner's capital account or current accounts as the case may be. Now I am taking the question number 42 of the Goyal and Goyal. You see, the question runs as follows. After the accounts of the partnership have been drawn up and the books closed off, it is discovered that interest on capitals at the rate of 8% per annum as provided in the partnership agreement has been omitted to be recorded. The capital accounts at the beginning of the year stood as follows: A rupees 8 lakh, B rupees 4 lakh, and C rupees 3 lakh. Their profit sharing ratio was 2:1:1. Instead of altering the balance sheet, it is decided to pass necessary adjusting entry at the beginning of the next year. You are required to give the necessary journal entry. Now you see, we have to prepare a table showing the adjustment. You see, the particular column is there, then A, B and C, three partners, and the fourth column stands for firm itself. Now you see, interest on capital is always credited in the partner's capital account. So interest on capital is to be credited. As far as A is concerned, the 8 lakh is his capital. At the rate of 8%, his interest becomes 64,000. Then for 4 lakh for B, it becomes at the rate of 8%, 32,000. And for C, at the on the capital of rupees 3 lakh at the rate of 8% per annum, it becomes 24,000. Combinedly 64,000, 32,000 and 24,000 being an expense for the firm becomes 1,20,000, and which is debited. What is credited for the partners will be debited for the firm. Now this 1,20,000 is the amount which would have been affected on account of the profit, or you can say that the interest on capital, if not provided, definitely 1,20,000 would have been distributed among the partners, which is to be taken back from the partners. So it is to be debited. So amount affected, that is 1,20,000 to be debited in the ratio of their profit sharing ratio, that is 2:1:1. So that comes 60,000, 30,000 and 30,000. And you see, 1,20,000 again will be credited as far as the firm is concerned. So you see, the 4,000 difference is to be taken now. This difference for A is 4,000 credit. The credit amount is more than that of the debit amount. Then for B also the credit amount is more than that of the debit amount, that is 2,000. And for C, the credit amount is 24,000. However, the debited amount is 30,000. So 60,000 debit is an excess. And as far as firm is concerned, it becomes nil. So there is no need to do any rectification as far as the firm is concerned. However, the rectification is to be done in the partner's capital or current accounts only. So by the amounts by which the particular partners are getting excess credit or excess debit are to be debited or credited accordingly. So you see, C's capital account is to be debited by rupees 6,000, and A's capital account is to be credited and B's capital account credited by rupees 2000. So the entry will be C's capital account debited 6000 to A's capital 4000 to B's capital 2000. This is the adjustment in respect of the interest on capital omitted in previous year's accounts. Now I am taking question number 44. A, B and C are partners sharing profits and losses in the ratio of 1:2:3. They have omitted interest on capital at the rate of 8% per annum for 2 years ended 31st March 2016. It means for the year ended 2015 and for the year ended 31st March 2016. Their fixed capitals were rupees 4 lakh, 6 lakh and 8 lakh respectively. So in this case, the whatever entry is to be made, single entry is to be made with the help of their current accounts because the capitals are fixed. Pass the necessary journal entry. So you see what is to be done. Analytical table is to be drawn. Particulars A, B and C and the firm itself. Now interest on capital for the first year it is 32,000, for B 48,000 and for C it is 64,000 and for the firm it becomes 1,44,000. Second years also the interest on capital will remain same because the capitals are fixed. So in case of A 32,000, 48,000 for B and for C 64,000 and for the firm it will be 1,44,000 is to be debited and for the partners is to be credited. Total credit amount for the partners will be for A 64,000, for B 96,000 and for C 1,28,000 and for firm the debited amount is totally rupees 2,88,000 which is the amount affected which is to be shared among the partners or to be debited among the partners in their profit sharing ratio. That is the profit or amount affected to be debited in 1:2:3 to be debited 48,000, 96,000, 1,44,000 in their profit sharing ratio and for firm it becomes 2,88,000 to be credited. So now the difference is to be calculated. 64,000 minus 48,000, 16,000 credit amount is in excess and for B it is 96,000 and 96,000 so there is no difference, nil amount will be there and for C it becomes 16,000 to be debited because debit amount 1,44,000 is more than that is of 1,28,000 and for firm it becomes nil. Accordingly the entry will be done and it is to be done with the help of the current accounts because the capitals are fixed. C's current account debited to A's current account 16,000. Omission of interest on capital for 2 years rectified. Now I am taking the question number 45. A, B and C are partners sharing profits and losses in the ratio of 5:3:1. After the final accounts have been prepared, it was discovered that interest on drawings had not been taken into consideration. The interest on drawing of partners amounted to A rupees 8,000, B rupees 6,000 and C rupees 4,000. Give the necessary adjusting journal entry. So the interest on drawing amounts is already given in the question. Analytical table is to be made. Particulars A, B, C and the firm. You see interest on drawing is always debited in the partner's capital or current accounts. Accordingly for A 8,000, for B 6,000 and for C 4,000. For the firm it will become 18,000 which is to be credited in the firm's books of accounts. However, the profit affected is 18,000 which is to be credited in their profit sharing ratio, that is 5:3:1. Accordingly for A it will be 10,000, for B it will be 6,000 and for C it will be 2,000 and 18,000 debited again. So the difference amount is for A it is 2,000 credit, then B nothing is there, 6,000 minus 6,000 nil it becomes, and for C it is 2,000 to be debited and for firm nil. So the entry will be C's capital account debited to A's capital rupees 2,000 and it is adjustment in respect of the interest on drawings omitted in previous year's accounts. Now I am taking question number 47. A and B were partners sharing profits in 2:1 ratio. During the year ended 31st March 2016, A's drawings were rupees 50,000 per month, drawn in the beginning of every month. So you see that 50,000 into 12, 6 lakh becomes the total amount of drawings. And B's drawings were rupees 25,000 per month, drawn at the end of every month. After the preparation of final account, it was discovered that interest on A's drawings at the rate of 12% per annum was not taken into consideration. So only interest on drawing for A has not been considered. Otherwise, as far as B is concerned, it has already been taken into consideration. gave the necessary adjusting entry on 1st April 2016. So first of all, we have to calculate the interest on A's drawings. Total drawings are 50,000 into 12, rupees 6 lakh. Then average period is to be calculated. He is drawing in the amount he is drawing in the beginning of every month. Accordingly, the average period will be 12 plus 1 upon 2. That is the time lag after the first drawing plus time lag after the last drawing upon 2. So that comes 6.5 months. So interest on drawing for A will be 6 lakh into 12% at the rate of into 6.5 months upon 12. So that comes rupees 39,000. Accordingly, the analytical table is to be prepared in which particulars A, B and the firm is to be mentioned. Interest on A's drawings is to be debited, and it is to be debited for A only 39,000 because as far as B is concerned, it has already been taken into consideration. His interest on drawings has already been taken into consideration, and for firm it will become 39,000 to be credited. So this is the profit of the firm which would have been affected, so to be shared among the partners, between the partners in the profit sharing ratio, that is 2:1. So it comes for A 26,000 and for B 13,000, and for the firm 39,000 debited again. So the difference is for A it is 13,000 debit and for B 13,000 credit. Accordingly, the entry will be A's capital account debited to B's capital account for the amount of 13,000, adjustment of omission of interest on A's drawings.